What is up, YouTube? Welcome back to the Stacks by the Numbers, and today is Tuesday. We have a little over 2 hours to go before the close, and I wanted to do just a quick review here of a company that is technically a brand name in the space. There's like a lubricant company for like rusted bolts and gears, works on machinery and whatnot. Probably a name you guys are familiar with. They're posting earnings today after market close. Name of the company, WD-40, ticker symbol WDFC, listed here on the NASDAQ. This is a stock that over time has been pretty consistent. Now, obviously, we ran to these highs here in 21, and we had the big pullback in 22, which we actually saw with a lot of stocks. But you can see that from that bottom point, the company has really been rocking and rolling. Actually, it looks like we're forming, having a good bounce off of this fib and actually forming a potential flag taking place here, a potential bull flag. And also, looking back since the company last reported earnings, you can see a gap up, and we've kind of been channeling down into this little consolidated situation here. So if these numbers, in my opinion, are just even semi-decent, we may potentially pop out here and run up into the 280s, which would be hitting a new 52-week high. But if we back up over time, I mean, look at this. Look at this. This is WD-40, right? A company that sells, again, spray lubricant in a can, used for machinery, rusted bolts and nuts and whatnot. And you would think, again, a company like this may not have this kind of appreciation over time. But not only is the business pretty much stable, really, over that entire time, but also the company has basically been consistently increasing their dividends, and they always pay them out. So it's known as a stable brand name in the space, right? So in my opinion, chances are I would more lean towards the call side as opposed to the put side, even though, of course, anything can happen. But even if we gap fill back down here to where we were, as you see back here, the high, top left of the screen, the O, the H, the L, the C, that's the open, the high, the low, the close. You can see the high, 245.76, right? But that is technically even higher than the lows of this channel. So worst case scenario, even if we gap fill right back here, maybe 244, as you see, you know, what are we talking, like 5-6% maybe? But obviously, really pending on what the company says, we could, of course, drop down out of the channel. But in my opinion, I don't think so. Again, I would lean more towards the call side here for earnings as opposed to the put side. This time 3 months ago, when they reported earnings last, the stock had a really big jump, going from 230 running to almost 280. So it moved about 14% instantaneously after last quarter's earnings. And as we look here, we can see the company beat very nicely on the EPS side by about 22.5%. And on the revenue side, coming in roughly $6 million, about 4.5% above these expectations down here, about the mid 130 million mark. And you can see that we hit that 140 million milestone again. And if we go back the last couple of quarters, we had a couple of quarters nice beats in a row. And before that, we had a couple of misses as well. But that was the tail end of 22. As you saw, stock pulled down nicely. And now we're basically been on a tear for about the last year and a half. But you can see 140 million the quarter before, above 140 million the quarter before. And here was right before we took that jump to that 140 million milestone, but we posted over 130 on estimates of 125. So now that we're seemingly holding that 140 million mark, we can look at estimates and we can see that the company, well, analysts are forecasting that the company is going to post around $1.11 a share on roughly $140.5 million. So in my opinion, again, you know, if I was a betting man, if I was going to take a position here going into earnings, I would probably lean more towards the fact that the company will be able to deliver that 140 mark, especially since they've been doing it for the last couple of quarters. But we have a market cap, we'll call it about $3.5 billion. We have a dividend yielding a little over 1.33%. The PE could be viewed as a little high. It's up here a little over 50. However, if we look back the last several quarters, we're actually lower than we were at some points. But the EPS side, even though it has been slightly slipping down, it doesn't seem to be the issue here. And in my opinion, it would be more about the actual revenue coming in. And of course, you want to make sure the company at least maintains, if not, you know, consistently continues to increase its dividend. But as you see here, the dividend has been pretty stable here, recently getting increased 2 quarters ago from 83 cents up to 88 cents. And now that ex-dividend date is April 18th, with the payment date coming out April 30th. Again, the difference between the ex-dividend date and the payment date, you need to be on record holding shares of this stock by April 18th to receive the dividend paid out on April 30th. But as we see here, 124 million up to 130, breaking up to that 140 plus million benchmark here, 141.7, back down to 140.4, back to 140.4, and now estimates of 140.5. So, of course, again, we know anything can happen. However, this is going to be Q2 now of 24, and we can see that this time last year, again, past performance technically does not dictate future results. But I will say that it seems this time last year, we had a nice bump of about 5.5–6 million in revenue going from Q1 to Q2. So even if we're not going to see a bump up in revenue, what this shows me is that Q2 is just as good, if not better, than Q1. And if Q1 was able to post that 140 million mark again, to have the estimates here basically the same at 140.5, again, that's why I'm saying, in my opinion, I'd probably give them the benefit of the doubt, and I'd probably make the assumption that they would probably meet or beat that revenue number. But looking at the forecast here, we can see we have one price target down here at 250. The rest are up here at 280. And recently we had a price target increase up to 313 a share. And in my opinion, I do agree with that, especially for the longer term. Again, that's how these analysts usually lay out these price targets. You know, they're looking 6–12 months down the road. They're not looking for where it's going to be next week. So, of course, given some time with how the company has been performing, 300 plus a share, in my opinion, I can personally agree with that. But right now, you can see we only have 3 analysts covering this situation. And we have 1 giving it a strong buy, 2 giving it a hold. Okay, fair enough. As you see, tail end 22 going into 23 seems to be the roughest part for the company. And before and after that, we had some nice beats here on the top and bottom line. And also moving forward, you can see we're getting to the very high 140 millions. Potentially even we may see 150 plus million milestone inside of the next quarter or two for WD-40. So over the longer term, this is something, obviously it's a little bit of a different company, but in my opinion, I kind of throw this in the category of a Coca-Cola, right? It's like a brand name that everyone knows. It's like slowly going to branch out and expand and consistently bring in those sales. And they keep paying out their dividend, and they consistently increase the dividend over time. So that's why, in my opinion, this seems to be like a very nice, well-known, stable staple in the space, if you will. But let's look at the financials real quick. First of all, we can see, again, over the years, kind of hit and miss, right? We have 2 beats on the fiscal year revenue side, 2 misses. If we switch over quarterly, we can see the last 4 quarters in a row doing very nicely. The annual side on the EPS side, we can see 3 misses the last 3 years in a row. If we switch over quarterly, though, we can see the company seemingly turned that around, has been beating on the EPS side the last 4 quarters in a row, right? And we know that a lot of these stocks, especially in this environment, in my opinion, they rally off of recent consistency and recent positivity. And I just think that because the company, again, has been beating on the EPS side, been beating on the revenue side, we're consistently seeing these dividends increasing. We've now held that $140 million revenue benchmark, milestone benchmark. I don't know. I use all these different terms, but you understand what I'm saying. We've been holding that 140 million mark now for the last couple of quarters. So that's why with estimates here at 140.5 million, I understand the stock is down. Market's, dropping a little bit today. But I think, in my opinion, again, I would personally lean more towards the call side as opposed to the put side. But you can see, look at this dividend increase here over the years, 237 a share back here in 19. We go into lockdowns here, 262. We come out 278, 306, now 327. So the company, in my opinion, it seems like over the years they have been trying to do the right thing by the shareholders. And again, we looked at the chart going back, 15 years or whatever it was. I mean, the company has really been doing very well over time. So that's why to look at a situation like this and to try to time a little dip and begin to build a position in a company like WD-40, in my opinion, may work out for you down the road. But looking here at the debt, we can see really not much debt here that this company's holding, about 160 million a couple of quarters ago. And we knew that the tail end of 22 going into 23 was their rough point. And this is how high the debt got, as you see, as of late, only 164 million. And now we're pulling back here in the last couple of quarters, 144 million, 128, 118, with cash on hand here of about 50 million and change. Positive free cash flow here was down at 8 million. Look at this, 8.4, and now clawed up to 33.5, 40.5, staying above 26 million. So we had a little drop there in the cash flow, but it is remaining positive. And of course, we took about 10 million and change off of our debt. So in my opinion, a lot of these numbers are trending in the right direction. We have assets outweighing liabilities. It's always a good thing. Switching over here to our balance sheet, we can see we've went up a little bit and then we kind of came back down. So we're kind of maintaining this 430 million asset range, which is fine because the liabilities, as you see, they did creep up to north of $250 million and have since been pulling back, now down to 214.6 million. That's the lowest it's been going back about the last 6 or 7 quarters. So in my opinion, that's a pretty good sign. Total assets minus total liabilities yields total equity. And we can see the equity was holding high 180s, 190s, and now we broke up above 200 million here. 2 quarters ago, 210 million. Last quarter, almost 216 million, which of course translate to a higher book value per share, as you see, low 14, sub 14, and then we just been consistently climbing up here, 14, 14 and a half, 15, 15 and a half. Now, as of last quarter, almost $16 a share. So, in my opinion, on paper, if you were to look at some of these metrics, I would say that the price to book ratio, as we see, could be viewed as a little high. And of course, the PE right now is just around 50. So if we were going to make an argument for a potential sell-off using a couple of those metrics, I can appreciate that. But overall, in my opinion, I just think it's the consistency and, I just think it's the necessity of the product that they bring to the table. That's why I think that the EPS and the revenue side really isn't going to be an issue. And this may be a situation, even if they, slightly miss on the EPS side or something today after earnings are reported. This is a situation where, again, they're probably still going to maintain their dividend, right? Moving forward, they're probably still going to increase the dividend for shareholders. We may potentially hear about a buyback after hours, right? That happened with, what did we just see? Dave & Buster's, right? We looked at Dave & Buster's. The company technically missed earnings by a mile. But what did they say? They said, we're opening up locations, we're buying back shares, boom. So the stock jumped up instead of dropping down. So you never know what these companies are going to say. But even looking at the annual revenue to market cap here, it's really not that out of whack because you can see it's been growing. First of all, it only took a very slight dip in 2020. And then you can see we've been consistently growing, now getting up to over 537 million for the year. And if we look, we're talking what, like 6.5, 7 times annual revenue? That's really not that out of whack. I mean, historically looking back, at a lot of companies that we looked at, we could potentially make the argument that it's a little bit high in the ratio. But in my opinion, I just think it's too much of a brand name in the space, too much of a staple for it to be viewed in that fashion, in my opinion. But also I wanted to show you the revenue again, 120, 130 million a couple of quarters ago. Boom. Now we jumped up to above 140 million. Right? But you can see on this 141.7, you can see the cost of goods was up here at 71, right? And it used to cost 70 to bring in 130. But now you can see we've maintained that 140, but the cost of goods has consistently been stepping down. Sub 70 million as of last quarter down to about 66 million. And what that does is total revenue minus cost of goods sold yields gross profit. And you can see the gross profit has been consistently increasing now quarter over quarter, going from 57 to the mid 60s, up here to above 70. Now, as of last quarter, 74.25 million. So in my opinion, a lot of these numbers are trending in the right direction. The operating expenses do seem to be slowly increasing. However, it's not outpacing the decline in cost of goods because gross profit minus operating expenses yields operating income. And you can see operating income was hanging out at the high teens. And now for the last couple of quarters, 22 up to 25, down to 23, back up to 24. So again, we do see these numbers slightly go up and slightly go down. But what I'm seeing, in my opinion, is consistency and stability. That's just the way I'm looking at it. The PE, as you see, was sitting here in the high 30s, potentially low to mid 40s here. Now we're currently sitting above 50. So that's why I can understand if someone wants to make the argument that the stock may go down instead of going up. However, it has seen some nice chunks after earnings for the last several quarters. So until the company breaks that trend, in my opinion, again, I would lean more towards, personally, the call side as opposed to the put side. Price to sales up here above 6. That's the highest it's been technically. Price to cash flow is down here at 30 times cash flow, though, and you can see before that, we were trading well over 100 at points here. 100 times cash flow, pulled back to about 50, and we've been hanging out in the high 20s, low 30s here. So it may potentially be viewed as fair valued here, looking from the price to cash flow ratio metric, in my opinion. But also the price to book, this is what I was talking about. See, now we're currently trading about 16.25 times book, which, as you see going back, is technically the highest it's been going back the last 7 or 8 quarters. So that's why it could be potentially in a situation where, like I said, we're in that consolidation zone, and even if the company does happen to beat earnings and everything's fine, we may potentially stay in that zone because the stock did go on a pretty big run. We are technically trading a lot times book. You understand what I mean? So of course we have to wait and see what the company says, but again, I have to say, in my opinion, I would lean more towards the call side as opposed to the put side. Return on assets now the highest it's been going back the last several quarters. Return on equity was up a little bit higher, but we've been clawing back up here to about 34%. Return on invested capital is the highest it's been, sitting here at 22.5%. Well, the highest it's been going back the last 7 or 8 quarters. Gross margin percentage got up above 50, pulled back above 50 as of last quarter, a touch below 53, so that seems to be trending in the right direction, in my opinion. Operating margin was up above 18, pulled back to 16.5, but now it's back up to about 17.25. So even though it did pull back, it has been staying up here in the higher teen range for the last couple of quarters. So that's why I feel like whatever speed bump that the company may have hit the tail end of 22 going into the beginning of 23, again, I would say, in my opinion, it seems like they have righted the wrongs. EBITDA, earnings before interest, taxes, depreciation, amortization, was down here in the 16s, got up to about 19.5, had a pullback to 18, but now we've pulled back up to 18.8%, which, again, technically it is down from that high we saw a couple of quarters ago. However, this number here is higher than where we came from when the company was struggling. So that's why I'm saying, in my opinion, it seems like they may have potentially turned everything around. The inventory turnover is one metric that we can see has been consistently decreasing. However, the asset turnover, for the most part, has been consistently increasing. And with the company not taking on too much debt and paying it down, while also at the same time increasing maintaining the assets, and slowly increasing the equity, you can see that our debt ratios here have been consistently decreasing over time. So that's why, in my opinion, again, we could maybe make the argument that it could slightly be overvalued. However, in my opinion, we can make the argument that a lot of stocks now are overvalued. So I don't think it's gotten to the out of reach level yet. That's why, again, seeing that price target forecast from that one analyst, 313, again, it may take several months, but in my opinion, chances are the stock will probably slowly and surely climb up to that 300 plus mark. And we can see moving forward now, even next quarter, the company's forecasting almost 150 million, looking to maintain the high 140 millions. Revenue has been consistently increasing for the most part. This is the bread and butter, obviously, the maintenance products, the main lubricant in a can, if you will. The U.S. market, as you see, prior to lockdowns was about 150 plus million. Now we're above 200 million. So U.S. revenue has grown roughly 33% over the last couple of years. Definitely nothing to sneeze at, in my opinion. You had a slight dip here in the EMEA segment, if you will. Going from about 208 million down to about 190 million. However, other sectors here, Asia Pacific, consistently increasing for the most part, getting up to just about 80 million. And we had a slight dip here in the Americas. However, interestingly enough, looking at the Americas, we can see that the company, here we go, analyst D.A. Davidson, 313 a share. I agree with that. We can see right here, WD-40 to acquire Brazilian distributor, Theron Marketing. So now they're buying out the distributor, as you see, 6.9 million. Company was holding, like 50 million in cash that we saw as of last quarter. So in my opinion, that's a drop in the bucket. And basically, I have to assume, even though it's not good to assume, but basically, it seems like they're just kind of trying to streamline this business here, right? And just kind of not necessarily cutting out the middleman, but just absorbing it to just kind of take care of business itself, right? So, in my opinion, again, something like a situation like this, I feel like it's probably going to benefit them in the long run. Otherwise, in my opinion, they wouldn't have bought out the distributor to begin with. And again, 6.9 million, not necessarily a large amount of cash for a company like WD-40. So, in my opinion, probably a good move. Again, that happened back on March 4th, so that was roughly a month ago. But in my opinion, I think that was a good move. Maintained at buy. This was 3 months ago. D.A. Davidson put out their price target increase, and we can see this is these are the numbers that came out last quarter. You can see shares rose 14%. Beat on the EPS side. Rose 140 million from 124 a year earlier. Analysts were expecting 134. Fiscal EPS forecast 478 to 515 on 570 to 600 million. Three analysts expect EPS of 510. Okay, so in my opinion for 24, the EPS may potentially come in light for the fiscal year EPS number. However, we've kind of seen the company be hit and miss on the fiscal year revenue and EPS side, and in my opinion, it doesn't seem to really affect the price of the stock. It seems like it moves more quarter over quarter as opposed to year over year. But also, you can see, look at the sales here, forecasted 574.8 million. That is near the very, very low end of the range here. The company expecting 570 to 600 million. Analysts expecting 574.8 million. So that's why I'm saying, in my opinion, I think that the revenue the company is actually potentially going to bring in is going to outpace what analysts are expecting. And I think that that, in my opinion, is going to help propel the stock higher and potentially hit new 52-week highs. But, of course, only time will tell. Anything can happen. But, again, you can see we're in this kind of consolidating zone here since we had this pull-up, and now we're kind of just channeling down. So that's why one of two things here, right? Either A, we're going to have great numbers, and we're going to pop out of the zone, back up to the high 270s, potentially hit a new high. Or B, we're going to have a little bit of a disappointment, and we're going to drop down to the bottom of the zone here, potentially maybe about 243 and change, and then kind of try to step down and bounce and potentially stay in this channel going into next quarter's earnings, which would be early July. So only time will tell. In my opinion, I'd say the low of the low, potentially right here, this fib, 232 and 3/4. On the high, I think we do hit new highs, and you know, if it's a nice beat, and I think we could see 280 plus, in my opinion. RSI basically middle of the road, sitting here a touch below 53. The stock recently got a little bit of momentum here, breaking out above the top Bollinger Band, now pulling back below this 50-day moving average, 258.62. In my opinion, really doesn't matter where the stock closes today or even what it did today. It does look like it climbed up and stayed above the mid-Bollinger Band, though, as of late. That's the first time since the end of February. MACD recently crossed to the upside. This is what I'm saying. The stock sold off kind of in this consolidated range. Now we found the bottom. The U-turn is beginning. We have the MACD crossing, right? We have momentum coming into these earnings, and that's why I'm saying, in my opinion, if they do beat estimates, boom, you're going to see a potential pop up there, 278, 280, 282, and we may see new 52-week highs. On the miss, a drop to the, again, sub-bottom Bollinger Band, excuse me, potentially the low 240s, like that 243 range right back here from that gap up, in my opinion, is possible as well. On the weekly, we can see the stock has been, for the most part, trying to stay above that mid-Bollinger Band. Looks like it's right at it right now, just off by a couple of bucks here, 253.38. Stock's at 256. But we can see that as the stock bottomed out tail end of 22 and then went on a rip here throughout 23, we can see that our bottom Bollinger Band has now gone from sub 150 up to almost $229 a share. So now we're in a much, much tighter range, which in my opinion is a very, very good thing. And as well as the 50-day moving average as well was down here, looked like about $175 a share. Now it's sitting here almost at 2.25. So these moves, and again, see something like the 200-day moving average as well. Going back, yes, first half of 21, it was a while ago. However, you can see this 200-day moving average was at 160. Now it's at 212. Right? So we're talking over a 25% move here over time. And that's what I always say, in my opinion, is a very, very good sign. A part of your capital, in my opinion, should be invested into these slow, steady movers and growers. Because now, over time, as the stock grows, as I mentioned, now we have nice higher support levels here at this new higher bottom Bollinger Band, at this new higher 50-day moving average, at the new higher 200-day moving average. You understand? But here the RSI basically still middle of the road, sitting here at about 57 1/3. So, of course, anything can happen. But see here on the weekly, top Bollinger Band, 278.06. In my opinion, I think that's where the stock goes. And I think we could see a quick, maybe 9-10% potentially breakout of that consolidation zone that we've been in here for the last couple of months. Let's check the pivot points very quickly. I'll let you go. Yeah, so we can see big resistance here at about this 270.39 level. And if we do happen to get a good report and we do happen to pop up to the top Bollinger Band again, roughly 278 and change, that would bring us above this resistance level, which could potentially bring us to the next resistance point of a little over 300 here at 302.48. Let's switch back to the daily. And we can see that the stock is basically bouncing right off of a key level right here, 256.32. We can see the stock 256.04. So again, we have earnings coming out. So whether it closes, in my opinion, above, at, or below this pivot point is really irrelevant because the numbers are going to tell us more of a story. But we can see next resistance level 266, in my opinion, should break through that no problem if the numbers are decent. And the second resistance level, what do you know? It's at 278 and change again, 278.90. So that's why, in my opinion, I would, if I had to and wanted to take a position on WD-40 going into earnings, I would lean personally more towards the long side. I would be bullish. I would lean towards the call side, in my opinion. And again, I would potentially be looking for about 280. But overall, if you're not much of an earnings option player, I know I'm looking at it because they're posting earnings today. But again, overall, in my opinion, just backing this up over time, again, minus your slight hiccup there, I mean, look at this growth over the years, you know? So that's why a situation like this, in my opinion, may be worth throwing on your watch list for your longer term portfolio positions, right? And if the company does happen to release some slight negativity, this earnings report, boom, all of a sudden it takes a hit back down to like we said, the low 240s, maybe 243. Maybe it slowly sells off to like 238, 236, right? In my opinion, I actually like it up here at 256. So if it could sell off maybe to 236, in my opinion, I would probably be a buyer of that dip because over time, again, the company has been looking very, very well over the years. And also on the technical side, again, as I mentioned, we have a potential bull flag setting up. So we have a lot of situations that could be pointing to a breakout to the upside. However, we all know it's up to the company now, and it's up to the actual numbers that they report. The technicals can only get us so far. But yeah, I always like WD-40, and I saw they were reporting earnings, so I figured I'd do a quick update video. But if you guys are playing the earnings, or if you guys have been a long-term shareholder of WD-40, let us know down in the comments section. And of course, if you see it the opposite that I potentially do, and you think the company may miss, or you think some negativity is going to come out, and the stock may take a hit down to that, low 240 level we were talking about, let us know down in the comments section as well. But obviously, anyone who's stepping in for earnings, I wish you the very, very best of luck, and I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel, and of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, and they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day.